Marcus thought he understood the stock market, not in the way a trader understands it, not with charts and moving averages and the particular vocabulary of someone who watches tickers for a living, but in the way a reasonable educated adult who has been contributing to investment accounts for 15 years understands it. He knew it went up and down. He knew it went up more than it went down over long periods. He knew diversification mattered and fees mattered and that trying to pick individual winners was a game most people lost. He felt like he had the basics. He felt like participation, combined with patience, was the complete picture. He was missing 5 things, not 5 obscure technicalities buried in academic literature. 5 specific behaviors, 5 structural decisions, 5 things the market rewards with a consistency and a magnitude that the standard investment conversation almost never addresses directly. Not because they are secrets, they are documented, researched, quantified, and available to anyone willing to look. But because the financial media ecosystem that most people absorb their investment education from is built around activity, around decisions, around the compelling drama of what to buy and when to sell and whether now is a good time to get in or a dangerous time to be exposed, the 5 things the market actually rewards are not dramatic. They do not make good television. They do not generate clicks or podcast episodes or the particular excitement of feeling like you are doing something sophisticated with your money. They are, by every aesthetic measure, boring. And boring is precisely why they work, and precisely why most people never fully commit to them, and precisely why the investors who do commit to them quietly accumulate more wealth over a lifetime than almost everyone around them who is working considerably harder at it. Let's go through all 5. The first thing the stock market rewards is time in the market rather than timing the market. And the gap between these two approaches is so large and so consistently documented that it should end the conversation about market timing permanently. It does not end the conversation. The conversation continues because timing feels like intelligence and patience feels like passivity, and we are wired to prefer the feeling of intelligence over the feeling of passivity, even when the passivity produces dramatically better outcomes. Here is the data that should settle it. Dalbar, a financial research firm, publishes an annual study called the Quantitative Analysis of Investor Behavior. They compare the actual returns earned by average equity fund investors to the returns of the S&P 500 index over the same period. In their most recent 20-year analysis, the S&P 500 returned approximately 9.9% per year. The average equity fund investor returned approximately 6.3% per year over the same period. Same market, same years, same underlying securities. A 3.6% annual gap between what the market offered and what the average investor actually captured. That gap exists almost entirely because of timing decisions. Investors pull money out during downturns when prices are low and fear is high. They put money back in during recoveries when prices are higher and confidence has returned. They buy high and sell low, not because they are irrational, but because the emotional experience of watching a portfolio drop 30% is genuinely distressing, and the brain's response to genuine distress is to make it stop. Selling makes it stop. Selling feels like a decision. Staying feels like doing nothing, like passivity, like accepting the loss rather than escaping it. But the market rewards staying. Not because staying is comfortable, because the market's best days are almost always clustered around its worst days, and missing the best days is catastrophic. JP Morgan Asset Management publishes a recurring analysis of what happens to a $10,000 investment in the S&P 500 over 20 years if you miss the best trading days of that period. If you stayed fully invested for the entire 20 years, your $10,000 grew to approximately $64,844. If you missed the 10 best days over those 20 years, 10 days out of roughly 5,000 trading days, just 10, your balance dropped to $29,708, less than half, from missing 10 days. Days that you would have missed because those 10 best days almost always occur within 2 weeks of the 10 worst days. You cannot time out of the crash and back into the recovery. The recovery happens before the fear subsides. The market rewards the investor who was already there when it happened. Marcus missed days, not many, but enough. During the 2020 pandemic drop, he moved a portion of his 401k into a money market fund for 6 weeks because the speed and severity of the decline felt unlike anything he had experienced before. He got back in 6 weeks later, after the market had recovered approximately 40% from its bottom. He locked in the loss at the bottom and missed the fastest recovery in market history on a portion of his portfolio. He has never calculated exactly what that cost him. He does not want to. The market does not care about his reasons. The market rewarded everyone who stayed and charged everyone who left, and it did so in the specific way markets always have, by recovering faster than the fear that caused the exodus, making re-entry feel dangerous just long enough for the best days to pass. The second thing the stock market rewards is low costs, and the margin by which low-cost investing outperforms high-cost investing over long periods is large enough that it should be the first and last criterion in every investment decision. It is rarely anyone's first criterion. It is usually somewhere behind historical performance, fund manager reputation, and the particular emotional comfort of a fund name that sounds like it was designed by people who know what they are doing. The math on fees is simple and devastating. 2 investors each put $100,000 into the market at age 35. Investor 1 chooses an actively managed mutual fund with a 1.0% annual expense ratio. Investor 2 chooses a total market index fund with a 0.04% annual expense ratio. Both earn the same gross return of 10% per year before fees. After fees, Investor 1 earns 9.0% net. Investor 2 earns 9.96% net. Over 30 years, Investor 1's $100,000 grows to approximately $1,326,768. Investor 2's $100,000 grows to approximately $1,716,338. The difference is $389,570 from a 0.96% annual fee difference. From a number so small it fits in a decimal point, $389,570. Gone. Not to market losses, not to bad investment choices, to a fee that most investors never consciously registered because it was expressed as an annual percentage of assets rather than as a dollar amount that leaves the account visibly every month. If your fund charged you $1,300 in a single transaction labeled management fee every year, you would notice, because it is expressed as 1.0%, deducted continuously across 252 trading days per year, you do not notice. You see the net return and assume that is what the market produced. It is not what the market produced. It is what the market produced minus what the fund company extracted. The market does not reward the investor with the best fund manager. The market rewards the investor with the lowest fee drag on an otherwise identical market return. This is not a controversial position in financial academia. It is the consensus view supported by decades of research, including the foundational work of William Sharpe, who demonstrated mathematically that before costs, the average actively managed fund must match the market because active managers in aggregate are the market, and after costs must underperform it by the amount of those costs. Not sometimes, mathematically, always in aggregate by exactly the fee amount. The investor who understands this and chooses index funds with expense ratios below 0.05% is not settling for average returns. They are capturing above-average net returns by eliminating the fee drag that pulls the average investor below the market's actual performance. Marcus had a fund in his 401k carrying a 0.82% expense ratio for 11 years before he switched it to a 0.03% index fund. He has not calculated the precise cost of those 11 years. The back of envelope estimate is uncomfortable enough that he has filed it under things he cannot change and moved forward. The third thing the stock market rewards is tax efficiency, and the gap between a tax-efficient investment strategy and a tax-inefficient one compounds over decades into a difference that dwarfs almost every other variable except time in the market and costs. Most investors think about taxes once a year when they file. They look at the number the brokerage sends them, recognize it as something they owe, pay it, and return to thinking about which investments to hold. They do not think about the structural decisions made at the account level, which types of investments live in which types of accounts, that determine how much of their gross return they actually get to keep. Here is the framework. Tax-advantaged accounts, the Roth IRA, the traditional 401k, the HSA, exist to shelter investment returns from annual taxation. Inside these accounts, dividends are not taxed as they are paid, capital gains are not taxed as they are realized, and the compounding happens on the full pre-tax return every single year. In a taxable brokerage account, dividends are taxed in the year they are received, short-term capital gains are taxed at ordinary income rates, and the compounding happens on a slightly smaller number every year because a portion of the return leaves to cover the tax bill before it can compound further. This sounds like a small difference. Over 30 years, it is not a small difference. An investor who holds a dividend-producing index fund inside a taxable brokerage account in a 24% tax bracket and who reinvests dividends after paying tax on them annually will end up with approximately 20 to 25% less at retirement than an investor who holds the identical fund inside a Roth IRA where dividends reinvest without any annual tax event. Same fund, same contributions, same market, 20 to 25% less from the placement decision alone. Asset location, the strategy of deliberately placing tax-inefficient assets like dividend stocks, REITs, and bonds inside tax-advantaged accounts and holding tax-efficient assets like broad index funds in taxable accounts is one of the most powerful and most consistently overlooked tools in the investor's toolkit. It requires no ability to predict the market. It requires no fund selection skill. It requires one structural decision about where each type of asset lives, made once, maintained automatically, producing compounding tax efficiency for decades. Marcus had been holding his dividend ETF in his taxable brokerage account and his growth index fund in his Roth IRA. He had it backwards. The dividend ETF, which throws off taxable income every quarter, belonged inside the Roth where those dividends could reinvest without a tax event. The growth index fund, which generates minimal dividends and can be held for decades without a taxable event until sale, was better suited to the taxable account. Swapping their locations cost him nothing and immediately improved his long-term tax efficiency without changing a single investment. The market rewards tax efficiency not by caring about your tax situation, but by compounding whatever return you give it. Give it a larger number by eliminating unnecessary annual tax drag, and it compounds the larger number. Give it a smaller number by allowing avoidable annual taxation to reduce the base, and it compounds the smaller number. The formula is indifferent. The structural decision is yours. The fourth thing the stock market rewards is behavioral consistency during volatility, and this is perhaps the most undervalued edge available to any investor because it is the one that is hardest to manufacture through intelligence or research or access to better information. The market drops. This is not a risk, this is a certainty. Over any long investment horizon, you will experience multiple declines of 20% or more. You will experience at least one decline of 40% or more. You will watch years of accumulated gains evaporate in weeks. You will do this while the financial media describes the situation in terms calibrated to maximize your anxiety because anxiety drives engagement and engagement drives revenue. You will do this while people around you make decisions that feel prudent, reducing exposure, moving to cash, waiting for things to stabilize, decisions that feel like risk management but function as wealth destruction because they convert paper losses into permanent ones and remove the investor from the recovery that invariably follows. The investor who contributes the same fixed amount every month regardless of market conditions is not ignoring the volatility. They are exploiting it. When the market falls 30%, the fixed monthly contribution buys 30% more shares than it did before the decline. When the market recovers, and it has always recovered, across every decline in modern market history, those shares purchased at the bottom appreciate at the same rate as every other share. The investor who continued contributing through the bottom owns more shares of the recovery than the investor who paused. They did not need to time the bottom. They did not need to predict the recovery. They needed only to continue the automatic transfer that was already scheduled. This strategy is called dollar cost averaging, and it is taught in every introductory finance course and practiced consistently by almost nobody, because the month you most need to continue contributing is always the month it feels most insane to do so. The month the market is down 40% is not the month that feels like a buying opportunity. It is the month that feels like everything is broken and the rules have changed, and this time is different. It is never different. The rules have not changed. The formula still runs. The recovery still comes. The investor who was already there when it arrived is the one the market rewards. Marcus has been through 3 significant market downturns since he started investing. He paused contributions during one of them. He reduced contributions during another. He maintained full contributions through only one, the 2022 rate hike-driven decline, and it is the only one of the 3 where his behavior did not cost him a measurable portion of the subsequent recovery. He did not maintain contributions in 2022 because he had suddenly become more disciplined. He maintained them because by 2022, he had automated everything, and the automation continued while he watched the decline with the same anxiety he'd felt in 2008 and 2020. The automation saved him from himself. The market rewarded the automation. The 5th thing the stock market rewards is simplicity, and this one cuts against almost everything the investment industry is built to sell you. The investment industry profits from complexity. Complex products justify higher fees. Complex strategies require advisors. Complex decisions require research tools and premium subscriptions, and the particular kind of confidence that comes from feeling like you understand something most people don't. Complexity is the product. The industry is very good at making simple things appear complex, because complex things are monetizable in ways that simple things are not. But the data on investment returns assembled across decades and dozens of market environments by researchers with no financial stake in the outcome tells a story that the industry would prefer you not spend too much time with. The story is this: a 3-fund portfolio, a U.S. total market index fund, an international total market index fund, and a bond index fund, held at low cost, rebalanced annually, and left alone, has outperformed the vast majority of actively managed portfolios, sophisticated multi-asset strategies, and professionally curated investment solutions over every significant time horizon measured. Not because simplicity is a magic formula, because simplicity eliminates the drag, it eliminates fee drag, it eliminates the trading costs of complex strategies. It eliminates the behavioral cost of maintaining a complicated system through volatile periods. It eliminates the tax drag of frequent rebalancing, and it eliminates the performance drag of the well-documented tendency of active managers to underperform their benchmark net of fees over long periods. The simple portfolio wins, not by doing more, but by avoiding the cumulative cost of everything that more involves. Marcus spent years believing that a sophisticated portfolio would outperform a simple one if he just found the right funds and the right allocation and the right advisor to guide him through the complexity. He paid an advisor 0.85% of assets annually for 4 years in his early 30s. The advisor built him a 12-fund portfolio with exposure to small-cap value, emerging markets, real estate investment trusts, preferred stocks, and 2 different actively managed bond funds. The portfolio was genuinely sophisticated. It underperformed the Vanguard 3-fund portfolio over those same 4 years after the advisor fee by approximately 2.3% per year. Marcus does not blame the advisor. The advisor was competent and attentive and genuinely believed in the strategy. The strategy simply could not overcome its own cost structure. None of them can, consistently over long periods. He has 3 funds now: U.S. total market, international total market, and a bond fund. He rebalances once a year in January. He pays 0.04% in combined expense ratios. He does not think about it between January reviews. The portfolio is boring in the way that things that work reliably are always boring. So here is what the stock market rewards, assembled into the one paragraph that Mr. Aldridge and every financial educator and every well-meaning family member who ever gave investment advice should have led with. The stock market rewards the investor who stays in it regardless of what is happening, who pays as little as possible in fees, who keeps every possible dollar sheltered from annual taxation in the right account structures, who contributes automatically and continuously through every market environment without exception, and who holds the simplest possible portfolio rather than the most sophisticated one. That investor does not need to be smart about the market. They need to be consistent with a structure. They need to automate everything that can be automated and then resist every subsequent instinct to interfere with what they have set in motion. The market is not a test of intelligence, it is a test of behavior. And behavior, unlike intelligence, is entirely within your control. Here is exactly how Marcus restructured his approach after understanding these 5 things and how you can do the same. Step 1. Automate every investment contribution so that no monthly decision point exists between your paycheck and your investment account. Set up a recurring transfer from your checking account to your Roth IRA, your brokerage account, and any other investment vehicle on the day after every paycheck. The amount goes out before you have decided anything about this month's money. Remove the human decision from the process. The human decision is the point of failure. The automation is the solution. This single structural change eliminates the behavioral cost that the Dalbar study documents, costing the average investor 3.6% per year. It does not require discipline after setup. It requires one decision made once. Step 2. Audit every investment you hold and replace anything with an expense ratio above 0.10% with the lowest cost equivalent available in your account. Go into every account you hold, 401k, Roth IRA, taxable brokerage, HSA, and find the expense ratio column. Anything above 0.10% is costing you money that the market is not responsible for and that you have not agreed to consciously. Find the lowest cost total market, or S&P 500 index fund available in each account and switch. The switch inside tax-advantaged accounts triggers no tax event. The switch inside a taxable brokerage account may trigger a taxable gain if the fund has appreciated. Evaluate before switching and consider waiting until the position qualifies for long-term capital gains treatment if it hasn't been held for a year yet. Step 3. Review your asset location and confirm that your most tax-inefficient holdings are inside your most tax-advantaged accounts. Dividend-producing funds, bond funds, REITs, and any fund with high annual turnover belong inside your Roth IRA or traditional 401k, where their income does not trigger an annual tax event. Growth index funds with minimal dividend yield can live in your taxable brokerage account, where they can be held for decades without a taxable event until eventual sale. If you find your allocations are reversed, if your dividend stocks are in taxable and your growth index funds are in the Roth, consider swapping over time as opportunities arise, being mindful of triggering taxable events in the process. Step 4. Simplify your portfolio to the fewest funds required to achieve your target diversification, and commit to that structure for a minimum of 5 years without modification. For most investors, 3 funds accomplish everything a 12-fund portfolio accomplishes at a fraction of the cost and with dramatically less behavioral risk. U.S. total market for domestic equity exposure, International Total Market for Global Diversification, a bond index fund for stability and rebalancing fuel during equity downturns. Set your target allocation, something like 80% equity and 20% bonds in your 40s, shifting gradually as you age. Rebalance once per year if the allocation has drifted more than 5 points from target. Otherwise, do not touch it. The instinct to tinker is the enemy of the simple portfolio. The simple portfolio only works if you leave it alone. Step 5. Create a written investment policy statement and read it during every market decline before making any portfolio decision. An investment policy statement is a one-page document you write during a calm market period that records your target allocation, your investment rationale, your time horizon, and your explicit commitment to continue contributing and not sell during market downturns. It should include the Dalbar data on what market timing costs. It should include the JP Morgan data on what missing the best 10 days costs. It should remind you in your own words written during a rational moment why the strategy you are running was built to survive exactly what you are currently experiencing. Read it before you touch anything. Most people who read it do not touch anything. Most people who don't have one do. Marcus has one now. He wrote it on a Sunday morning, the way you write something you want to remember. It is 2 pages, not 1, because he had things to say about 2020 and what it felt like to miss the recovery and what he would do differently and why. He reads it every January when he does his annual review. He has not read it during a market decline yet because he has not yet experienced a significant market decline since he wrote it. He is aware that he will. He is aware that the document will matter more in that moment than it has in all the calm Januaries combined. He is aware that the person who reads it in a falling market and does nothing is a different investor from the person he was in March of 2020. Not because he knows more, because the structure is different. Because the automation is in place and the simple portfolio is running and the decision points have been removed and the written record of his rational self exists for his panicking self to consult. The market rewards these 5 things. Not intelligence, not sophistication, not the ability to read a balance sheet or interpret a Federal Reserve statement or understand the geopolitical implications of a supply chain disruption. It rewards time, low costs, tax efficiency, behavioral consistency, and simplicity. It has always rewarded these things. The research is unambiguous. The outcomes are documented across decades and market cycles and every conceivable variation of economic environment. The only question is whether you will let the market reward you for them, or whether you will keep doing the interesting thing instead of the boring thing and let the gap between what the market offered and what you actually captured quietly widen for another 15 years before you sit down on a Sunday with a spreadsheet and try to calculate what the interesting thing cost you. Marcus calculated it. You do not have to.